Welcome to Explain the Charts, everyone. Today, December 4th, 2025, we're taking an in-depth look at the S&P 500, specifically through the lens of the SPY ETF. The broader S&P 500 index closed yesterday, December 3rd, at 6,849.72, showing a significant rally in recent months. Our SPY daily chart, which tracks the index, shows a closing price of 683.89 for December 3rd, indicating a strong upward trajectory. If we observe the entire one-day chart, stretching back to July 2024, we see a remarkably bullish trend unfolding. The market has climbed from its 52-week low of 483.04 in April 2025 to near its 52-week high of 692.34 recorded in late October. This impressive ascent is largely fueled by sustained hopes for Federal Reserve interest rate cuts, which have been a recurring theme in recent news. Additionally, the continued optimism around artificial intelligence, despite some recent disappointing reports on Microsoft's AI initiatives, has been a significant tailwind, particularly for chipmakers like NVIDIA and AI infrastructure providers. Let's narrow our focus to the period from April to November 2025 to truly appreciate the magnitude of this rally. From the lows around 483 in April, SPY has established a clear uptrend, with each dip finding solid buying interest. We can identify a key long-term support level around the 650 mark, where price found resilience after previous pullbacks. The high volume witnessed during the rebound from the April lows underscores strong institutional accumulation and conviction in the market's direction. Now, let's zoom further into the most recent action, looking at October through early December 2025. We can see SPY approaching its 52-week high around 692.34 from October, which now acts as a significant resistance level. There was a noticeable dip in early November, where prices pulled back to the 670 to 675 range, possibly reflecting some market uncertainty or profit-taking after hitting those highs. This brief reversal might correlate with reports of a major market disconnect or black swan event warnings cited by various analysts around that time. However, the market quickly rebounded, pushing back towards those previous highs on renewed rate cut hopes and generally positive geopolitical developments like easing U.S.-China trade tensions. The current price action suggests that breaking past this 692.34 resistance will be a crucial test for the bulls. Transitioning to the one-hour chart, we gain a more granular perspective on the mid-November pullback. Here, we can observe the short-term downtrend from around 676 down to approximately 652. This period showed increased intraday volatility as sellers took control. However, this hourly chart also clearly illustrates the strong bounce back from those 652 lows. This reversal on the hourly time frame was a precursor to the sustained upward movement we now see on the daily chart, reinforcing the bullish momentum heading into December. For the immediate short term, let's examine the 15-minute chart, covering December 1st to the early hours of December 4th. The current price as of 0:54 Universal Time Coordinated today, December 4th, stands at 683.57. We're seeing relatively tight trading ranges, indicative of market consolidation and anticipation. Immediate resistance can be seen around 684.50, which SPY has tested multiple times without a decisive break. On the downside, a short-term support level has formed around 680 to 681. The steady futures mentioned in the news align with this relatively stable intraday price action, suggesting a wait-and-see approach from many traders before significant moves. Volume has been moderate during this consolidation, with no major spikes to indicate strong directional conviction yet. Recapping our analysis, SPY has shown remarkable strength since its April 2025 lows around 483. A critical long-term support level sits near 650, while the 52-week high of 692.34 remains a key resistance. Currently trading around 683 to 684, the market is poised at a pivotal juncture. For a bullish scenario, a decisive break above 692.34 on strong volume, perhaps reinforced by positive inflation data or clearer Fed signals, could propel SPY towards new all-time highs. Deutsche Bank's prediction of an 18% S&P 500 increase in 2026 lends credence to this outlook, with a moderate to high likelihood given current momentum. Conversely, a bearish scenario would see SPY reject the 692.34 resistance, potentially breaking down through 680 and then 670, with a retest of the 650 support not out of the question. This could be triggered by hawkish Fed surprises, escalating geopolitical tensions, or a widely feared unraveling of the AI bubble, as suggested by some analysts like Michael Burry. The likelihood of this scenario is moderate, especially with warnings of a market disconnect and anemic 2026 performance based on historical cycles. Traders should closely monitor upcoming economic reports, especially the Personal Consumption Expenditures Report and any further comments from the Federal Reserve. Also keep an eye on major tech earnings and evolving geopolitical situations, as these will likely dictate SPY's next big move. Remember, this analysis is for informational purposes only and not financial advice. Always conduct your own thorough research before making any investment decisions. Thank you for watching Explain the Charts, and we'll see you next time.